Warren Ingram with Personal Finance this evening. The legitimate tax revolt is what we're going for this evening. And really it is, we're tarting it up to be something it isn't. It is the 31st of January. People are going into fill in their tax returns to the end of February 2019. During February, creating their estimates, figuring out what they've earned, how much tax they've paid. And for many people, they might want to put extra money into a retirement annuity. And there's some more adventurous ways of reducing your tax liability.
Yeah, so it's time for us as taxpayers to be revolting in the best way possible. I thought about that the whole day.
You did, and you delivered it beautifully.
Terribly. So I think you're right. There are a few options and a few things to consider before the end of Feb. And the one, I guess, always the most obvious one will be to look at your retirement fund contribution. So whether you do that inside a retirement annuity, inside your company retirement fund, and most of those nowadays are provident funds. The trick there is make sure that you've contributed the maximum that you're allowed, and the law says 27.5% of your taxable income. So whether it's rent or interest or your normal salary or your commissions or whatever, 27.5% of that.
So if you earned R1 million a year, you could put 275,000 rand basically into a retirement annuity.
Yeah. And there is a limit of 350,000 as a max that you can contribute per year. So if you're earning a huge amount of money, you might not be able to get a full tax break on 27.5% of the whole thing. So just note it's 350,000 as a contribution. One of the questions we're facing quite a bit right now is people coming back and saying, that's fine, I've been doing that for years, but I'm not doing it this year because of this prescribed assets that's come up from the anti-elective election manifesto, and I think it's a concern. It's something to be aware of, and kind of the way I'm pivoting almost on this is to say, if you've got a provident fund, make the contribution, because at least you've got flexibility with provident funds. You can make a radical decision if you need to later, if this becomes a real issue. RAs, it's a known. You just need to know that you won't be able to access the money until you're 55, and that this prescribed assets thing is on the radar. So it's enormously frustrating.
It's on the radar, but not inevitable, although Mark Barnes was implying on Tuesday night that South Africa's got no choice but to go into pension savings and help themselves and hopefully deliver a return.
Can we talk about that, or do I have to move on?
No, please, let's talk about that.
Okay, so
it's important to talk about that. It's an issue.
Yeah, it is an issue, and I don't like the fact that someone sitting in a state-owned enterprise is talking about it. That's the problem for me.
Yeah, he wasn't talking about it as a state-owned enterprise, although he is a state-owned enterprise
he
does need a bailout.
Yeah.
He was doing it as a columnist in Business Day, which makes him objective.
Yeah, no, it doesn't. It's not. And so let's just start with the most obvious point now. There is no, he can't argue the point. There is no state-owned enterprise in South Africa that struggles to get money when it's well managed. I think when we chatted about it last time, I mentioned the Land Bank as an example.
Yeah.
And there isn't one, he cannot come up with an example of a good one that struggled to get funding when their corporate governance is in line and they manage the business correctly. I'm not saying they have to be massively profitable. They just need to convince the bondholders, the people that want to give them money, that they'll be able to repay the money. Step one. So what he does in that column is he says, you have to separate corporate governance from fundraising.
No.
And I'm saying right there, you've fallen over. Yeah. He then goes on to make actually quite a nice point, which I wish he just made that point and stopped, which is, why don't we give people incentives? Why don't we allow small direct retail investors to fund state-owned enterprises? And I would go one step further. These RSA retail savings bonds, which they've launched, which still exist, why not direct that money and then do one thing better? Allow people to earn that interest rate tax-free, because that would get a flood of money for the well-managed ones. But don't tell me as a retirement fund member that I've got to contribute to all state-owned enterprises and then I think allow unfettered looting of places like Eskom to continue and then say, no, don't worry about the corporate governance. That really gets my blood boiling. So okay. I'm sorry, Mark Barnes, I don't agree with you.
All right, good. I didn't agree with him either. We had a robust discussion. Now, on to, so retirement annuities, we've touched on that. There is the other thing we've been as Westbrook have been advertising on the radio, this thing called Section 12J. It's been on the books, I think, since about 2012. It was quite, there were some quite punitive, sort of
terms and
conditions in it, so nobody paid attention until about 2 years ago. And suddenly the world has gone mad, and now there are 150 Section 12J funds, and every person who's recently retired from the corporate world has decided to open up a Section 12J fund, and it's become a feeding frenzy.
So what's interesting about this little bit of history is our beloved Pavlo has a little bit to do with the reason why these things became more popular, because he lobbied like crazy, along with other people, to make them more palatable to investors, to actually get a proper tax break in a practical way. So well done, Pav. He actually, he deserves a bit of credit.
So he is useful.
He is useful. Yeah.
Oh,
he has
that's useful. Good to know.
So very briefly, what happens is the purpose of this whole thing is you make an investment into, and it's specifically the venture capital. In other words, these are basically new businesses or businesses that are creating new employment or new opportunities. So it's very specific in the purpose, and you make a contribution or an investment, not a contribution, to these things, and you leave your money there for a period of time. It must be 5 years, is the point, and you get a major tax deduction. So if you put in 100,000 rand, you write off 100,000 rand against your tax in this year.
So if you'd earned 1 million, and you wanted to reduce your tax liability, you'd put 100,000 rand into a Section 12J, and you'd only pay tax on 900,000 rand of your income, not 1 million.
Exactly right. And you get it.
That's big.
It's a big thing. And you get a tax certificate from this 12J provider, because they are regulated. They can't just, you can't just pop up with one tomorrow and say, hey, I'm a 12J, let's do this.
And this is very important, because if you are considering a Section 12J investment, and because they are quite new and because there are so many of them, there are going to be some that are going to let you down.
Yeah.
And you've got to go into these things
eyes wide open.
So eyes wide open. You've got to know exactly who's running them. You've got to know what their expertise is. You've got to know what it is that they're investing in, and quadruple check that they are certified by the South African Revenue Service, that they've got the appropriate tax certificate.
And they need a license from the FSCA, so from the Financial Services Conduct Authority, to be fund managers, actually. So that's one of the things that they have to be. But just to understand the context of how does this fit into a person's portfolio. So this to me fits in the same category kind of as high risk hedge funds, or any kind of hedge fund in fact, and private equity funds. This is not where you take your core big savings that are meant to be there to kind of secure your retirement one day, and you say, I'm taking 80% of all of that and I'm putting it into a 12J. Understand that by definition, they're called venture capital companies. In other words, these are very new businesses. And as we know, new businesses, yes, if they work, they're fabulous. You can get a great return. That's wonderful. But just understand that, like marriages, not all of them are going to work in life when you start out. Great ideas, great intent, but there are huge risks to any new business for an investor. So if it's me and I'm talking to someone, I'm saying to them, this is where you allocate sort of 5% of your portfolio at the max. It's better than a Bitcoin investment, but you need to understand that there are risks with this.
Because the temptation would be looking at the stock market performance over the last 5 years, and the fact that you've got practically zero return in real terms over those 5 years, because the market has not kept up with inflation.
Correct.
And so people then lose faith in markets and go, why must I keep putting money into my RA, which has cost me a bundle of cash to keep going? I'm actually poorer today as a result of the money I put into my RA in real terms than I was 5 years ago. That's a terrible idea. I know. We can either go to the horses, we can go to the casino, or we can trust the nice man with the smile and the clipboard who says, I've got a 12J fund.
Yeah, and so let's talk about just the things to look at with these 12Js. The big concern I have with them is the moment an investment starts to get hyped on the radio, and we start hearing that brand name people that were famous for another reason are now promoting any kind of investment. For me, that's a huge red light there and then, because what it's doing is it's creating hype to attract investors into a type of investment, and that, I don't like that. For me, that's a huge concern there and then. The second point is, you need to look at something, an investment like this, and say, forget about the tax break. Is this a high quality investment that has a good chance of working on its own? Forget about what all the tax breaks that I could possibly get out of it. Those are secondary benefits.
I remember meeting a salesman once. A financial advisor. A salesman once, probably about 15 years ago, and we're talking about retirement annuities and stuff, and saying, even if the market underperforms, even if you lose 40% of the money in this fund, it doesn't matter, because you got the tax break of 40%. You're 40% ahead ahead already. So you can lose 40% of this and you'll still be ahead rather than paying the tax. The sale was on the tax break, not on the benefits of long-term investing, the benefits of long-term saving, the prowess of the fund manager, the ability of markets to outperform over time, and all of the good stuff that comes out of real investing. The salesmen were punting on the break, and that's what scares me about 12J. And I don't think the SMOSA have got their clutches into this particular sector yet. But I wouldn't be surprised when people go to financial advisors and they're going to get pushed in the direction of 12Js because people are angry about the way in which the country's money has been managed and are looking for an excuse not to pay tax.
Yeah. And to me, I think, unfortunately, I think the SMOs are there already. So I think I'm not, and just to be clear, I'm not saying all 12Js are bad, just like all private equity funds are not all bad. You just have to do your homework. And my last point on that one is please check the fees of these things. So, like the private equity space, when they're charging you 2% a year and 20% of outperformance of some arbitrary benchmark.
But again, what is the benchmark? Because when we beat our benchmark, we take 20% above that. What is the benchmark? Well, it's about 8%. Well, that's a lousy low benchmark for the amount of risk you're asking me to take.
So to me, a real benchmark here, you need, if you look at the stock market, even with the last, 5 years of bad performance, over long periods of time, the stock market gives you about 12.5% a year, and that's the benchmark. So 7.5%.
Except for the last 5 years.
Yeah. So if you say 6 or 6.5% a year above inflation, okay, that's a good starting point for something like this. And bearing in mind, it's more risky than the average, share on the stock market. So you need to get a premium above that before someone starts to earn a performance fee. And that to me is the starting point. The moment someone says to you, when we beat inflation plus 2 or inflation plus 1 or just inflation, we're going to earn a performance fee.
You get that in a fixed deposit.
Just close the conversation and move on. And I mean, I did a bit of looking around because I'm kind of averse to things that just get sold for tax benefit. So which is wrong, I know. But I looked around there.
But no, is it wrong? No, hold on. Things that get sold just for a tax benefit, that is fine if you only going in to get the tax benefit. But if you're going in believing not only are you getting a tax benefit, but you're also going to get an investment return, that second part of the equation is not guaranteed. So you're right to be cynical about these things.
And so there are some good ones. And I think that's the point. And you really just need to do your homework. And I think the point you made, just to emphasize, you look at the quality and the history of the people and, that are managing these and find out how long have they been actually managing venture capital type funds and what's their experience in that. Don't go and find someone who's just a brand name and they've chucked their name in this, I was a rugby player 5 years ago and now I know about venture capital companies. Please, that's not the way you do this. Because, I mean, ultimately that 5%, yes, you got a tax break on it and then you put it in and then you lost it all. There's no tax break there.
You're going to feel like a mug in 3 years' time when you look at your investment returns and you've lost 60% of the value of your money. And had you paid the tax, or had you just put it into retirement annuity, or had you just not been far too clever for yourself? So be mindful, I think, is Warren's argument here. When you go into and somebody offers you a Section 12J fund, you've got to be mindful of the consequences of the underlying investments going bad, because they could.
Yeah, and then one of, I mean, maybe just to move on before I get assassinated by the 12J providers, the other things that we just need to touch on are, don't forget that your tax-free savings accounts that you've got until the end of this tax year to do for the previous one.
And just to reiterate there, this is after tax money. Tax-free savings account gives you a future benefit. You don't get a benefit now from a tax perspective.
Yeah. So you're allowed 33,000 Rand a year, and it's in the tax year. So just know that's now that's ending now at the end of Feb, and then it starts again obviously in the 1st of March for the new one. So when the market's been as depressed as it has, you might want to kind of accelerate your tax-free savings contribution in the beginning of March. So that's just something to consider. And then for people that are looking at the rand at the moment and saying, wow, this rand's rather strong, it's suddenly I think it was about 13.30 the last time I looked. It's starting to get into kind of the range that I've always been talking about of 13.50 to the dollar. So
13.29 this evening, 17.47 to the pound, 15.23 to the euro.
So look at that. If you do your discretionary allowance, which is R1 million per person per year, then just know that from
who are you talking to?
I'm not saying you have to do the whole million. You can do 10,000 rand. Come on.
But it's just the economy's tight and money is scarce.
And that's why we got to save like crazy, because we got to build for the future. And so at the beginning of March, you can use your discretionary allowance again to do your offshore investments if that's what you need to do. And so looking at that rand is really what's attractive to me now. But I think, and it's one of the points I wanted to make all along in this market and in the climate we're in now. We're so pessimistic. You talk to people all the time. They're really bleak about how things are right now. And I'm feeling quite bullish and quite optimistic about, and I'm not saying because the economy suddenly going to grow at 5%. That's crazy to predict that. But I think when there's so much negativity and there's so much pessimism, there are fantastic bargains to be had. And I think that's the point now. Look at these tax vehicles that you're getting and the opportunities that you've got to make investments and take advantage. Now's the time to be greedy when others are fearful. And that's where we are.
Warren Ingram from Galileo Capital. He's a financial advisor. He's an executive director at Galileo Capital. The legitimate tax revolt encouraged by South Africa's National Treasury, here on The Money Show.